The central bank in the United States and the board of directors met today and they decided to hold interest rates steady, no change in interest rates. They did, however, make some comments that could affect the trajectory of interest rates. And in fact, following the meeting, the 10-year government bond yield increased and the 30-year government bond yield increased. Why did that happen? I'll discuss that in this video here. I'll also talk about what these changes could mean for stock market investors, and I'll use Palantir stock as an example, and I'll look at how Palantir's valuation changes based on the changes in interest rates derived from this meeting. So it's going to be an interesting video. I always like to do these every time the central bank has a meeting because their impacts on interest rates make a big difference for stock market investors like you and me. So let's take a look. I quickly wanted to let everyone know about this great offer for my channel members at the investor tier. You can gain access to my spreadsheet containing my ratings on over 130 stocks. I update this spreadsheet with multiple times and multiple changes per day, Monday through Friday. Additionally, channel members at the investor tier can get access to my spreadsheet with my discounted cash flow valuations, and I update this spreadsheet multiple times per week with multiple new companies added to this spreadsheet with discounted cash flow valuations. There's already dozens on the spreadsheet available now. You can get all this plus early access videos, plus member exclusive videos, plus priority response to comments, all for less than $15 per month. So what are you waiting for? Hit that join button below and start experiencing the benefits. Okay, so on January 29th, 2025, the Federal Reserve issued their FOMC statement. And in their statement, they said that recent indicators suggest that economic activity has continued to expand at a solid pace. The unemployment rate has stabilized at a low level in recent months, and labor market conditions remain solid. That being said, they also say that inflation remains somewhat elevated. And according to my observations of the labor market and inflation, I find these statements to be true. Let me share with you. So the Federal Reserve said that unemployment has stabilized at a low rate. And what they mean by that is if you look at 2023, the unemployment rate reached a low of around 3.4% in January of 2023, and then it started on a rise. And this was alarming. You see the unemployment rate jumping from 3.4% all the way up over 4.25%. And this was a steady and consistent rise. This is why a lot of companies were concerned about a potential recession because the unemployment rate just kept going up and up and up. But you see in recent months, that unemployment rate has stabilized. It is not going up anymore. In fact, you could argue it might be going down or staying flat. This is a 3-year chart of the unemployment rate. Let me share with you the 1 year. So if I share with you the 1-year chart, you can see since about August of 2024, the unemployment rate has been steady or declining. And so the Federal Reserve is less concerned now about a potential recession as a result of rising unemployment. The fear of this is why the Federal Reserve in their previous 3 meetings cut interest rates. When they cut interest rates, it increases economic activity because lower interest rates means lower monthly payments for cars, so people buy more cars. It means lower monthly payments for mortgages, so people buy more homes. It means lower interest rates on your credit cards, and so people spend more on their credit cards, etc., etc. It ignites economic activity, lower interest rates does. Higher interest rates has the opposite effect. And so the Federal Reserve was fearful of a recession, and so they were lowering interest rates to slow down that increase in unemployment. And so now that unemployment has steadied, they're not so afraid of a recession, and that's one of the things they said. They also said that the inflation rate is higher than they would like it to be. And you can see that as well in the chart. So I can share with you the 1-year US inflation rate, and you can see from April of 2024 all the way to October of 2024, there was a steady decrease in inflation. And that is what the Federal Reserve wanted to see because inflation was above the 2% target. They target 2% because 2% is a healthy rate of inflation. If we have 0% inflation, people would spend less money because they would not feel like if they don't buy the thing today, that it would be more expensive tomorrow. That's what drives some economic activity as people are thinking to themselves, if I don't buy this car today, and if I delay my purchase for 6 months or 1 year, the newer model is going to be more expensive. So I might as well buy it today. That's why the Federal Reserve targets 2% inflation and not 0% inflation. 0% inflation is too close to deflation. And if there's deflation, prices are going down, that would really slow down the economy because people would say, well, instead of buying this car today, let me wait another 6 months because the price will be lower. And then let me wait a little more because the price is going to be lower. And that would feed on itself in this negative virtuous cycle. And economic activity would really slow down, especially in the United States. That's driven by consumer spending. Consumer spending is more than 2/3 of the US economy. And so that's why they target those numbers, those figures. But you could see there, the inflation rate had been coming down. And then since October, that downward trend has stopped and inflation is actually rising now. And the big thing that's going to create and has created more inflation are the election results. Since October, the probability that the Republicans and Donald Trump would take over created enthusiasm in financial markets, which created an increase in asset prices across the board. Cryptocurrency prices increased, all kinds of stock prices increased, and so that created an increase in wealth, which then created more spending in the economy because people felt wealthier. And that trend has continued. Stock prices and asset prices are significantly elevated from October levels. And so that's creating this higher inflation. And so that's what I mean when I say that I agree with what the Federal Reserve said in saying that inflation remains elevated and unemployment looks solid. A key statement here is also they note that the economic outlook is uncertain and the central bank is attentive to the risks to both sides of its dual mandate. They have to consider both unemployment and inflation, and these are offsetting forces because more unemployment would mean lower inflation. More jobs means more inflation because people have more money and they go out and they spend that money and that creates higher prices. So they're counter forces and they need to balance those counter forces. And right now, the central bank is saying that these forces are about equal. There's risks on both sides. Whereas 1 year ago, it was clear that the risk was for too much inflation. And then 6 months ago, the risk was that unemployment would be too high because you saw that chart I showed you with unemployment rising. But right now, they see it as roughly equal. And so what this means is they're unlikely to lower interest rates by very much in 2025 unless these factors change. And I don't see these factors changing. I don't see any of these policies by the newer administration to bring down inflation. In fact, most of the policy choices, most of the policy decisions, and the tax cut expected are likely to be inflationary. So if you're hoping for more interest rate cuts, I think this meeting suggests otherwise. I think there's going to be fewer interest rate cuts than expected and higher overall interest rates in 2025. Okay, so what does higher interest rates mean for your stocks? Higher interest rates means lower valuations for stocks. And the reason why, the mechanism that creates that factor is because when you invest in a government bond, it's essentially zero risk. And so if you can invest in a government bond that gives you a higher interest rate, that's the starting point that stocks have to compete with. They have to give you at least that amount because you're taking a risk when you're investing in a stock, whereas with the US government bond, you're not taking as much risk. There are risks involved, but not as much as investing in a stock. So I've created these discounted cash flow valuation models, and I do this for dozens and dozens of companies. And the number that's critical for what we're talking about in this video, the central bank, is the risk-free rate. That's the rate that the central bank impacts mostly, the US government bond yield. And it's an input to my valuation. And let me share with you, what you want to look at is the intrinsic value per share. Right now for Palantir, I have that at $19. Watch what happens when I increase the interest rate, the risk-free rate. From 0.45%, I'm going to raise this to 5%. So I'm going to change this input to 0.05. And you can see the intrinsic value per share fell from $19 down to $17.86. So higher interest rates is likely to mean lower stock prices. And the change in the price depends on the company. If the company has more cash flows expected longer in the future, the change in the value will be greater. The magnitude in the change will be greater based on the change in the magnitude of interest rates. They will be more sensitive to valuation changes based on interest rates. So a company like Palantir, which does expect most of its cash flow to happen in the future, not in the next 5 years, will have a more meaningful change in valuation than a company like Coca-Cola. Okay, so I hope that provides an explanation of the central bank's policy decision today and what it could mean for stock prices like Palantir. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.